I think the entire digital assets economy is exploding and growing in a bunch of different dimensions. Right now, the way to think of it is that half of the economy is built around Bitcoin. It's digital capital. Bitcoin is digital gold. And the killer application on top of digital capital is digital credit. Instruments like Stretch, STRC, credit instruments that pay yield.
And it can help the smallest and the lowest demographic. If you can just put away any money and you can buy a fraction, 1/100 millionth of a Bitcoin to start, it's just, there's something there for you to buy that cannot be debased. And that's why we did this, is that we really believe in this system and in Bitcoin in the future. So
Bitcoin's price, currently stabilizing around $95,600, finds itself in a classic consolidation phase, having sharply retreated over 20% from the $126,000 peak achieved in early October. This correction, marked by $1.5 billion in net ETF outflows recently, and a dip into extreme fear sentiment on the Fear and Greed Index, has tested the resilience of market participants. Technically, the focus is squarely on holding the psychological and structural support zone between $94,000 and $92,000, which aligns with key Fibonacci retracement and long-term moving averages. A decisive break below this range could trigger a deeper flush, but should it hold, expert projections for November see the price potentially reclaiming $110,200, with year-end targets reaching the $128,000 to $135,000 zone, contingent on renewed institutional demand. The underlying bullish narrative remains robust, underpinned by the ongoing supercycle of institutional adoption, where corporate treasuries and spot ETFs, now holding millions of Bitcoin, cement Bitcoin as a superior macro asset. Crypto analysts like Michael Saylor and James Lavish consistently champion this view, arguing that Bitcoin's programmed scarcity and long-term store of value function make it the essential counter-asset to fiat debasement. This institutional conviction, despite short-term volatility, indicates the market is simply resetting leverage before the next significant macro-driven push. Let's take you back to the interview for more details on Michael Saylor's latest price prediction for Bitcoin.
I think we all want to go to the moon, but if you want to ride the rocket, you got to be prepared to pull the G's. Over 5 years, Bitcoin's had like 6 brutal drawdowns. If you roll the clock back 13 months, we were sitting around 68,000. And then after the Trump election, we had this incredible rally from 68 to 106,000 in 5 weeks. If you go back 14 months, we were about 55,000. And so if you'd said we're going to go from 55,000 to 94,000 in 14 months, that would have exceeded any reasonable investor's expectations. Over 5 years, Bitcoin's up about 50% a year on average for the 5 years. Gold and S&P are studying the cost of capital to 14%. My company's strategy is up 71%, equivalent to NVIDIA. There's no other stock in the S&P that's done any better. So I think the volatility comes with the territory. If you're going to be a Bitcoin investor, you need a 4-year time horizon, and you need to be prepared to handle the volatility in this market.
So when you look at the price right now, and then we'll talk about the implications for strategy, but when you look at the price right now, what does the upside at this moment look like to you, and what does the downside in this moment look like to you?
I feel like we put in a pretty strong base of support around here. There's an incredible amount of leverage coming out of the system, a lot of liquidation. A lot of the OG holders were selling at the $100,000 level, and so I'm fairly comfortable at this level. I would think that we'll build from this base and we'll rally from here. Obviously, it's hard to make a forecast for the end of the year right now, given what's happened over the past few weeks, and especially the shift in the macro environment. But, as you know, my view is Bitcoin's going to outperform gold. It's going to outperform the S&P. It is digital capital. And so if you're a long-term investor, this is the place to be. Well, it's pretty important to note that we're not even 1.15 times levered. We're very fractionally levered, and our debt that we have is 4.5 years out. So we don't really have any trigger points anytime soon. And if Bitcoin were to fall 80%, we're still over collateralized and we're fine. So our balance sheet's pretty stable. The company's strategy, just like an intelligent bank, would be to build amplification for the common stock using preferred equity. So the equity never comes due. It's a dividend payment declared by the board. It's not a coupon. We can't be in a default. There is no credit default situation from the digital credit that we're selling at this point. I think the entire digital assets economy is exploding and growing in a bunch of different dimensions. Right now, the way to think of it is that half of the economy is built around Bitcoin. It's digital capital. Bitcoin is digital gold. And the killer application on top of digital capital is digital credit. Instruments like Stretch, STRC, credit instruments that pay yield. And that's a very simple business. The other half of the economy is digital finance. And it's going to be built on the proof of stake networks that are emerging, the Ethereum Solanas, the BNBs. And the killer application for that part of the digital assets economy is tokenized currencies, a la stablecoins, tokenized securities, tokenized real-world assets, tokenized brands, and DeFi in general. Well, that's a very complicated technical development, and I'm sure that stablecoins are going to go from hundreds of billions to trillions of dollars, but it's not really competing with digital capital. No rich person wants to buy the currency instead of an equity or a real estate or a capital asset.
Michael, given where Bitcoin's trading right now, are you buying?
We are buying. We're buying quite a lot, actually, and we'll actually report our next buys on Monday morning. I think people will be pleasantly surprised. In fact, we've been accelerating our purchases.
Are you ever not buying, Michael?
No, we're always buying. Bitcoin's always a good investment.
But no, that's interesting, though, in terms of buying today at $95,364 versus buying 2 or 3 weeks ago. You're saying you were buying it at both. If you were to look over the last year, sort of at your average, do you weight the buying based on trading?
We now own nearly 3.1% of the network, and we bought it on a blended average about $74,000 a coin. The point that I would make for any investor is, if you have money you don't need for 4 years or longer, and if you don't trust anybody, you want no counterparties, you just want to own a piece of the global digital economy, you buy Bitcoin. It's the commodity. If you're an equity investor and you want to bet on digital credit and you want to bet on digital capital and you want some amplification, you buy an equity like MSTR. Right. If you have money for less than 4 years and you're an investor and your time frame is 12 weeks, you should buy the digital credit. For example, the credit instruments we've created have stripped the volatility off of Bitcoin. Bitcoin's vol is like 45 on a trailing 30-day average.
Bitcoin has experienced significant volatility over the past 5 years, including 6 major downturns. Around 14 months ago, its price was about $55,000, and it surged to over $106,000 within 5 weeks following the Trump election, a performance surpassing many investors' expectations. On average, Bitcoin's annual growth was around 50%, compared to gold and the S&P 500, which averaged around 14%. This volatility is typical in Bitcoin investing, requiring a 4-year minimum investment horizon. Currently, the market shows a strong support base, with many longtime holders having sold at the $100,000 level, reducing system leverage and liquidation risks. Regarding risk management, Bitcoin investments are only lightly levered, with stable balance sheets that remain secure even if prices drop dramatically. The broader digital finance realm, including tokenized currencies such as stablecoins and DeFi applications, is expanding rapidly, but serves a different function than Bitcoin's role as digital capital investment strategies include consistent buying, with some investors accumulating Bitcoin over time at varied price points to manage volatility and long-term gains effectively. This approach reflects confidence in Bitcoin's potential to outperform traditional assets in the long run. Let's now return to James Lavish to hear his own view of the current market dynamics.
And now you've got the Fed battling these two different mandates. They've got the stable pricing, and They've got the full employment. We don't know what full employment is. It's just a kind of check the temperature of the country. Let's see where it is. But it's what they're really afraid of. What everybody's concerned about is, are we entering a period of stagflation where prices continue to rise and the economy rolls over? So that's kind of been on everybody's mind. And right as all that happens and the Fed comes into the fall and lowers rates, we have a government shutdown. So that government shutdown has now kind of taken liquidity out of the markets. What happens is the Treasury continues to issue debt and draw money out of the markets, draw it out of reserves, bank reserves. And, they can't spend it. It just goes into their checking account. It sits there. So that's kind of been this overarching issue that people have been watching and wondering when it's going to be resolved. Apparently, it's going to be resolved today with the House meeting. We'll see. The Senate has already passed a continuing resolution to get the government up and running again. But, and apparently that the House is going to follow suit, but you never know. So I'll believe it when I see it in the headlines and it's actually done. But that's kind of just big picture what's been going on. At the same time, you had the markets rip to all-time highs and kind of stay there. And you've had gold rip to all-time highs and back off a little bit, but it has been strong. It continues to be strong. Mm-hmm. And that tells you that there's a few things going on. It's trading at about $4,200 per ounce today. And that's telling you a number of things about not just the economy, but about foreign central banks and foreign entities, what they want to own. And is it U.S. Treasuries? Is that the global reserve asset, or are they starting to turn to gold? And how much of that gold pricing has to do with uncertainty in the markets of everything I just talked about? And so lower rates and continued deficits, which is what we get back to on, this fiscal driven economy that we live in. And so that's kind of the worry there, is that you've got this K-shaped recovery where, if you look at the consumer and you look at actually the two different demographics, and I posted about this recently, and I'll bring up the posters so you can see it, but the two different demographics and just how stark a difference it's been for the wealthiest demographic versus the less wealthy. And here's the net wealth of the top 1%.
Oh, wow.
Since 1990 versus the bottom 50%. You'd say, well, bottom 50% hasn't done that bad. Look at how big this white space is here compared to this way. It's done actually pretty well. But remember, this is the top 1%. Okay. Mm-hmm. So when you do out the math, the top 1%, here are the metrics. So per capita, the top 1% per person went from $1.8 million of net wealth to $15.5 million for a $13.6 million gain. That's an 8x multiple. The bottom 50%, remember, they're sharing all of that, right? They're sharing all the bottom 50%, you have 50% of people sharing this. So according to the demographics and the census from back in 1990, the bottom 50% on average had $5,700. By the end of 2025, they had $25,000 for a $19,000 gain. So they made 4x. They've gained 4x in wealth, half of what the top 1% did. So it's just getting worse. And that's really the concern here, is that we've got this, separation of wealth that's occurring because of the way that our economy is driven, and the debt-driven economy, that if you don't own assets, that you're being left behind, which gets all the way back to everything that we talk about every day and preach on owning gold, owning Bitcoin. I prefer Bitcoin, long-term. And this is what I write about in The Informationist every week is just how and why you should be owning assets and explaining in all the different things that are going on in the economy for people to understand that. And it's why we launched the Bitcoin Opportunity Fund. David Foley, my partner, and we are extremely confident. I have super high conviction in Bitcoin as an asset and as a base layer for an economy that we need. And it can help the smallest and the lowest demographic. If you can just put away any money and you can buy a fraction, 1/100 millionth of a Bitcoin to start, it's just, there's something there for you to buy that cannot be debased. And that's why we did this, is that we really believe in this system and in Bitcoin in the future. So one of the things that confuses people is that, I ask any of your normal friends that are not neck deep in this stuff and talk about inflation. I do it all the time. I say, well, what do you think inflation should be? Like, what should the inflation rate be? And they say, well, I think it's about like 2%. That's good. And it makes you, because if you don't have 2%, then people will hoard their money and then it'll grind the economy to a halt because they won't spend and buy things. And they've been brainwashed into really truly believing that inflation is normal and not understanding that with technology, we should have deflation. We should be getting everything for less. Some people talk about it matches the rate that of gold extraction, but really, the best explanation I've studied or heard is that the New Zealand bank came out with it in the 90s, and everybody just gravitated to it. Now, why would it be 2%? It's a good question. If inflation is 5%, you're going to feel that, because in just 2 years, your spending, your purchasing power is down by 10% if your wage hasn't kept up. So in 5 years, it's down 25%. Everybody felt it in COVID. The official reading for inflation during COVID is that from 2020 to 2025, you lost 25% of your purchasing power. Now, you and I know that's probably understated.
Wait, can you repeat that one more time? How much purchasing power have we lost?
From 2020 to 2025, you lost 25% of your purchasing power. That's how much inflation it was.
Yeah.
And that's the official number. So now think about it. Let's go back to first principles. Why do we have inflation? Well, we should have deflation.
James Lavish explained that the Federal Reserve faces a challenging balancing act with its dual mandate of maintaining stable prices and achieving full employment, although full employment is not precisely defined and more like an economic temperature check. The key concern is whether the economy is heading into stagflation, a situation where prices rise while economic growth stalls. Complicating this picture recently was a government shutdown, which removed liquidity from the markets because the Treasury kept issuing debt but couldn't spend it, effectively draining bank reserves. While the Senate passed a continuing resolution, final approval from the House was still uncertain. At the time, Lavish noted the markets had reached record highs, with gold also climbing near all-time levels, reflecting both economic uncertainty and shifts in what foreign central banks might prefer to hold as reserve assets, possibly favoring gold over U.S. Treasuries. He described the economy as fiscally driven with persistent deficits and low interest rates fueling concerns about a K-shaped recovery, where wealth gains have mostly gone to the top 1%, who on a per capita basis have increased net wealth eightfold since 1990, compared to fourfold for the bottom 50%. This growing inequality underscores the importance of owning assets like gold and Bitcoin to protect wealth long-term. James Lavish also discussed inflation perceptions, pointing out many people accept around 2% inflation as normal, even though technological progress should cause prices to fall. He emphasized that official figures showed a 25% loss of purchasing power from 2020 to 2025, highlighting why owning assets is crucial amid this environment. As we conclude, which asset do you believe offers better long-term value preservation and financial inclusion? Bitcoin with its digital, divisible, and decentralized nature, or gold with its physical stability and historical role as a safe haven? Please drop your thoughts in the comments below, share this video, and hit your thumbs on the like button. Thanks for watching. Don't forget to subscribe.